So I want you to imagine that you're cruising down the highway.
Yeah.
You're in this sleek, completely silent, futuristic electric sports car, right?
That sounds nice.
Yeah, you're just gliding along. The suspension is absorbing absolutely everything. There's like not a single mechanical sound to be heard anywhere.
You're just in your own little bubble.
Exactly. You feel entirely detached from the physical world. But then, without any warning at all, the freshly paved asphalt just ends.
Oh, no.
Yeah. You hit this massive stretch of jagged, unpaved gravel, and the silence is instantly shattered. I mean, the dashboard is rattling, the steering wheel is fighting you, and you are just violently reminded that, well, friction, mass, and gravity still exist.
Yeah, that's an incredibly jarring transition. You go from feeling completely frictionless to, feeling the physical consequence of every single bump in the road.
Right. And welcome to bulls, bears, and the bell. I'm setting it up that way because that visceral shock, that's exactly what the global markets experience today.
It really is.
So for today's deep dive, we are unpacking a highly detailed market brief from In Today, Tuesday, August 18th, 2026. And looking through the sources, so the index closings, the sector rotations, the after-hours earnings, a very clear, honestly, almost cinematic theme emerges here.
Yeah, it's hard to miss.
We are watching high-flying, futuristic tech concepts just collide head-on with some very old-school, analog geopolitical realities.
It is a fascinating collision to witness.
Right.
And, whether you're actively managing your own retirement portfolio or you're just simply trying to understand the macroeconomic forces that will ultimately dictate the cost of your groceries, your mortgage, this data serves as a blueprint.
Totally.
We're going to cut through the noise of the closing bell to map out exactly where the capital is flowing and, I think more importantly, why it is flowing there.
Yeah, let's jump straight into the baseline mood of the broader market right now, which honestly, it feels a lot like a sudden summer hangover.
That's a good way to put it.
Because Thursday of last week, that was a massive record high party. Everyone was celebrating. But, by the time the bell rang today, the harsh fluorescent lights were basically turned on.
Yeah, the party's over.
The S&P 500 closed at 7,691.76. That is a drop of 0.7%, or about 53 points. And it marks the third straight day of losses since that record high.
Right. And the damage wasn't distributed equally either.
No, not at all. So the Nasdaq Composite, that took a much harder hit. It closed at 26,289.71.
Wow.
Which is down 1.3%. It basically shed over 350 points.
Yeah.
And the Russell 2000, which tracks smaller companies, that also fell 1.3% to 3,017.89. But here's the data point that really caught my eye. The Dow Jones showed some serious resilience today.
It did.
It only dropped 0.2% to 53,343.40. So I look at that and, I have to challenge the narrative a bit. Is the market actually panicking? Or are investors just deciding they'd rather hold boring, century-old industrial companies instead of volatile tech? Like, why is the Dow surviving this sell-off?
Well, you're touching on the exact mechanism driving today's action.
Yeah.
The market isn't experiencing some blind panic. It is executing a textbook sector rotation.
Okay, break that down.
To understand why the Dow is surviving while the Nasdaq bleeds, you kind of have to look at the anatomy of those indices. The Nasdaq is, as you know, heavily weighted toward growth companies.
Right.
Their valuations are largely based on massive profits that they promise to generate 5, maybe 10 years down the line.
Like we said earlier, they're selling a frictionless future.
Yes, exactly. But the Dow is fundamentally different. It is heavy on cyclical, defensive, traditional industries. It's full of companies that manufacture tangible goods and generate massive amounts of free cash flow right now, like today.
Real stuff.
Yeah. So when the macroeconomic environment gets nervous, capital rarely just evaporates.
Right. It has to go somewhere.
Exactly. It looks for a different home. So it flows out of those high multiple future promise tech stocks, and it flows into the immediate safety of present-day cash.
So investors are abandoning the shiny future and taking shelter in the boring present?
Pretty much.
And looking at the brief, the primary catalyst for that nervousness, it isn't an internal market failure. The panic is being imported. It's coming from overseas.
Yes, geopolitics.
The physical world is acting like sudden gravity on the market, and we saw that specifically in the energy sector today.
The energy sector was the undeniable outlier today. I mean, it was the sole winning sector across the board.
Yeah, it finished up 1.8%, and the catalyst there is escalating U.S.-Iran tensions. Now, just to look at the facts impartially here, right? Strictly as reported by the market brief, President Trump officially rejected a ceasefire extension.
Right.
And as a direct result of that geopolitical development, Brent Crude surged to $90.87 a barrel. And WTI hit $84.50.
Massive move.
And you saw companies tied to that physical infrastructure surge too, like Targa Resources, TRGP. They jumped 7.1%. ExxonMobil XOM climbed 2.6%. But, I mean, I want to push back on how we interpret this for a second.
Okay, go ahead.
Market algorithms, they scan headlines all the time, right? If oil is jumping specifically because of a political decision regarding a ceasefire, isn't there a chance the market views this as just a temporary blip? Like, why assume this is a long-term shift being baked in?
Well, it's because of the breadth and the velocity of the capital movement. The market does not process political decisions through an ideological lens, right? It processes them purely as supply and risk variables.
Just numbers on a spreadsheet.
Exactly.
Fair.
So when traders see a development like this, they don't just price in a 2-day supply disruption. They price in what we call a geopolitical risk premium.
Okay, break down that premium for the listener. What does that actually mean for a company's bottom line?
So think of a geopolitical risk premium as an invisible, unavoidable tax. And it's levied on the entire global economy based purely on uncertainty.
A tax on uncertainty.
Yes. When crude oil pushes past $90 a barrel, it instantly alters the basic physics of corporate America, because almost every single physical good we consume has to be manufactured using energy. It's wrapped in petroleum-based plastics. It's shipped across the country via diesel trucks or, cargo planes.
Which means if you were running a logistics company, your fuel costs just skyrocketed this afternoon.
And if you're a consumer packaged goods company, the cost to create your product just increased, which means your profit margins just shrank.
Wow, yeah.
So when institutional traders see $90 oil, they instantly recalculate their inflation expectations. Higher inflation historically forces central banks to keep interest rates higher for a longer period of time.
Which hurts growth stocks.
Exactly. That entire logical chain forces investors to sell off riskier, future-facing assets and run for the safety of the very energy stocks that benefit from the price spike.
Man, that perfectly explains the carnage in the tech sector today.
It really does.
If energy is the winner because of this geopolitical gravity, investors have to liquidate something to fund those new energy positions. And today, they liquidated the darlings of the tech and industrial worlds.
They sure did.
Information technology was the biggest loser. It dropped 1.94%, and the brief specifically cites overvaluation fears there.
Yeah, people are getting nervous.
So you have Micron, MU, falling 7%, and NVDA faced continued downward pressure. But here is where the story gets a little muddy for me.
Yeah.
Industrial goods also fell 1.74% today. And Eaton, ETN, which is a massive power infrastructure company, they dropped 5.5%. So, I mean, if NVIDIA is bleeding and Eaton is bleeding, doesn't that mean the whole artificial intelligence bubble is finally popping?
I see the logic there, I do. But the data within the sources points to a slightly different conclusion.
Oh, really?
Yeah, because there's a massive structural difference between a fundamental collapse of an industry and healthy, albeit painful, profit-taking.
Okay.
And Eaton is the crucial tell here. The brief explicitly notes that Eaton dropped due to, quote, investors locking in gains after a massive recent run-up in power infrastructure.
Ah, okay. So it's not that people suddenly think data centers are a bad investment. They just made so much money on the stock recently that they're, cashing out their chips.
Exactly that. What we're witnessing is the abrupt end of the AI honeymoon phase.
The honeymoon is over.
It is. For the last couple of years, a company could just mention the letters AI on an earnings call and their stock would surge. But we are entering the reality check phase now. Valuations for certain tech giants became so stretched that their stock prices assumed a decade of absolute uninterrupted perfection.
But perfection doesn't exist when oil hits $90 a barrel and supply chains get threatened.
Precisely. When a geopolitical shock hits, portfolio managers look at the massive paper profits sitting in their tech and infrastructure holdings, like Eaton, and they decide to hit the sell button, take their cash, and move it to safety.
That makes a lot of sense.
Right. Eaton provides the physical power management systems for data centers. The global demand for those systems didn't just evaporate at 2 p.m. today. The fundamental demand is incredibly strong, but the price of the stock simply got too expensive for a suddenly nervous market.
Well, that distinction makes a lot of sense. The foundation of the industry is solid, but the premium people are willing to pay for it just shrank.
Exactly.
And, that bridge takes us perfectly into the after-hours earnings reports, which reveal some incredible nuance here.
Yeah, the after-hours action is fascinating.
Because despite the daytime tech sell-off, specific subsectors of AI and the economy are absolutely thriving. It proves the tech trade isn't dead, it's just maturing.
Maturing is the right word. It's shifting from theoretical hype to physical execution. So what did the after-hours numbers show?
So, Keysight Technologies, KEYS, they popped 4.5% after hours.
That's a big move.
Huge. They delivered what the industry calls a massive beat and raise. Their adjusted earnings per share came in at $3.07, absolutely crushing the $2.48 estimate.
Wow.
Yeah, and revenue hit $1.85 billion against a $1.75 billion estimate. And the primary driver, AI data center testing demand.
Right.
But wait, I have to play devil's advocate here.
Go for it.
The broader market just severely punished NVIDIA and Micron during the regular session. Those are the brains of the AI revolution, right?
Yeah, are.
So if the brains are bleeding, how on earth is a testing equipment companies like Keysight jumping 4.5% on AI demand?
Well, because the market is shifting its focus from glamour to utility. NVIDIA is the glamour. They design the magical chips that generate the headlines.
Sure.
But you cannot simply plug thousands of NVIDIA chips into a wall and expect a data center to function. You need a massive, highly complex physical ecosystem to support them.
Okay, so how does Keysight fit into that ecosystem?
Think of building an AI data center, like constructing a 100-story skyscraper.
Okay.
NVIDIA might be designing the luxurious penthouse suites, but before anyone is allowed to move in, you have to stress test the load-bearing beams of the building. You have to prove the foundation won't crack under pressure.
Oh, I see.
And Keysight provides that highly specialized electronic testing equipment. Before a major tech giant flips the switch on a $2 billion data center, they need companies like Keysight to simulate massive data loads, test for latency, and basically ensure the power grid won't instantly melt down.
So Keysight is basically the building inspector for the AI revolution.
That's a great way to view it. And Keysight's massive earnings beat proves that the physical, structural build-out of AI infrastructure is happening right now at a record pace, entirely independent of the daily fluctuations of NVIDIA stock price.
The physical reality of the build-out is overriding the stock market sentiment.
Yes.
And speaking of physical reality, we have to talk about Toll Brothers and Home Depot.
Oh, yeah.
Because their after-hours numbers paint a very specific picture of the American consumer. Toll Brothers, TOL, the luxury home builder, they stayed relatively flat, down 0.4%.
Okay.
Now, they beat their profit estimates, posting $2.97 per share versus the $2.92 estimate. They hit $2.66 billion in revenue, but here's the catch. Their revenue was actually down 8% year over year.
Ouch. That 8% drop in volume is a massive macroeconomic signal.
Right, and it correlates with Home Depot HD. They reported a very strong Q2 earnings per share of $4.92 and reaffirmed their full-year guidance, but their stock still got dragged down by the broader market.
Yeah.
So synthesize this for the listener. Toll Brothers is highly profitable but selling fewer homes. Home Depot is making money, but investors are selling the stock. What is happening to the consumer here?
So we are seeing an intense filtering effect based on interest rates. Toll Brothers specifically caters to the affluent upper-middle-class buyer. The fact that they are maintaining strong profit margins shows that the top tier of consumers still has cash and is still willing to spend it. However, that 8% drop in volume, that tells us the overall pool of eligible buyers is rapidly shrinking.
Because of the cost of borrowing money?
Exactly. Analog constraints are squeezing out the middle class. If a family could afford a luxury home when mortgage rates were at 5%, they might be completely priced out when rates hit 7%.
Absolutely.
The high interest rates are acting as a barrier to entry, and they're leaving only the most well-capitalized, cash-heavy buyers in the market. And Home Depot reflects that exact same reality.
How so?
Well, they were performing fundamentally well, managing their operations efficiently to generate nearly $5 a share in profit. But the market is looking at the shrinking volume of home sales and assuming that eventually fewer new homes will mean fewer people buying lumber, paint, appliances.
It's just a matter of time.
Right. The macrogravity is pulling them down.
Which leads us directly to the final piece of today's deep dive. Those exact macro catalysts and the storm clouds waiting for tomorrow's opening bell.
Yeah, the pressures are building.
We've seen how geopolitics, energy, and shifting AI narratives played out today, but the systemic pressures underneath the market's floorboards are just getting incredibly intense.
Very much so.
The brief highlights three major macro hurdles. First, the 30-year Treasury yield hit 4.72% today. The sources note that is the highest level since 2007.
That is a staggering metric, honestly.
But let me pause you there because financial media throws around bond yields all the time, right?
Constantly.
So for a listener who mainly invests in tech stocks or index funds, explain the math of why a 4.72% yield on a 30-year government bond is so dangerous to the stock market.
It all comes down to the concept of the risk-free rate of return. A U.S. Treasury bond is considered one of the safest investments on the planet.
Right.
If the government is guaranteeing you a nearly 5% return every single year for the next 3 decades, that fundamentally alters the math of investing.
Because why would I risk my money on a volatile tech startup if I can get a guaranteed roughly 5% from the government?
That is the exact calculation every portfolio manager is making right now. To justify taking a chance on a risky growth stock, instead of buying that safe bond, the stock has to promise massive, explosive growth.
It has to overdeliver.
Yes. So as the bond yield rises, the hurdle for a tech company to prove its worth rises right along with it. A 4.72% yield mathematically compresses the valuation of every growth stock in the market. It makes the future look less valuable compared to the guaranteed present.
Wow. And that leads us to the second and third macro hurdles waiting for tomorrow. So tomorrow brings the release of the FOMC minutes, the internal notes from the Federal Reserve's latest meeting.
Everyone is watching this.
Right. And the brief notes that everyone is watching to see if the Fed remains hawkish. Now, for those not steeped in Fed jargon, hawkish essentially means a central bank is aggressively focused on killing inflation, usually by keeping interest rates uncomfortably high, much like a hawk swooping down on its prey.
Nice analogy.
Thanks. A dovish stance would mean they are softening up, preparing to lower rates to help the economy fly.
And the market is terrified they will remain hawkish,
Yeah.
especially given the third hurdle.
Right. The third hurdle is a massive trade policy shift. Tomorrow, new 50% import taxes, tariffs on Canadian goods take effect.
That's huge.
According to the sources, this is expected to significantly impact timber and retail prices. So again, viewing this strictly as a neutral market mechanic. A 50% tariff on a major trading partner is an enormous, sudden variable.
It really is.
If the importer has to pay a 50% tax at the border, they're going to pass that cost directly to the consumer. So if we connect all these dots, Toll Brothers' volume is already shrinking. Now, Canadian timber might cost 50% more. Oil is sitting at $90 a barrel. Aren't we staring down the barrel of a major inflation squeeze that will force the Fed to keep rates high?
We are absolutely staring down that barrel, and that is why the market is holding its breath. Let's synthesize the pressure cooker the Federal Reserve is sitting in right now.
Okay.
You have $90 oil, which immediately raises the baseline cost of global transportation and manufacturing. Simultaneously, you introduce a 50% tariff on Canadian timber and goods. So any new house being built, perhaps by Toll Brothers or any major renovation utilizing Home Depot materials, just became significantly more expensive to execute.
So you have energy-driven inflation and supply chain-driven inflation hitting the economy at the exact same moment.
Yes. Now, put yourself in the shoes of the Federal Reserve. Their primary weapon to fight inflation is raising interest rates to cool down spending.
Right.
But, as we just discussed, the 30-year Treasury yield is already at a post-2007 high of 4.72%. The Fed is walking an incredibly precarious tightrope here.
How so?
Well, if they act dovish, lower rates, and just ignore the oil spike and the tariffs, inflation could aggressively reignite and absolutely crush the purchasing power of the middle-class consumer.
But if they stay hawkish and keep pushing rates higher to fight that new inflation,
then they risk breaking the broader economy. Sending those yields even higher would decimate tech valuations and would freeze the housing market entirely. They're basically trapped between letting inflation run hot or actively engineering a recession to stop it.
wow, which perfectly explains the lead researcher's final note in our sources today. They are advising extreme caution on entering new tech positions until the market can see the Fed's exact stance in tomorrow's minutes.
Yeah, that makes sense.
There is just too much systemic risk on the table to make blind bets right now.
The structural setup requires a lot of patience. We have incredibly strong corporate execution, like we saw with Keysight's massive earnings beat and Home Depot's operational efficiency, and that's acting as a supportive floor for the market.
Right, the companies are doing their job.
Exactly.
Yeah.
But this volatile geopolitical backdrop, the surging oil prices, and these shifting macro realities, they are acting as a very heavy, unyielding ceiling.
So what does this all mean for the listener? Let's bring all these threads together.
Let's do it.
We started today looking at a market suffering a summer hangover. We saw an analog, oil-driven geopolitical shock from the Middle East ripple through the indices. That gravity dragged down tech heavyweights like NVIDIA and Micron in a wave of healthy but undeniably painful profit-taking.
But diving deeper, we found hidden resilience. We saw that the AI revolution isn't stalling out, it is simply maturing.
Right.
It is getting down to the hard, unsexy work of building the physical infrastructure, as proven by the surge in data center testing companies like Keysight. The foundational work is happening.
And yet, looming over all of this innovation are the macro hurdles. We've got 2007-level Treasury yields, shifting Fed policy, and massive new trade tariffs that threaten to squeeze the everyday consumer's wallet.
It is a tremendous amount of data to digest from a single day of trading. But, if I can offer a final thought for us to ponder based on the totality of these sources,
Absolutely. The floor is yours.
I think this Pacific Tuesday in August will be remembered because we are currently witnessing a profound clash of eras.
Okay, I like where this is going.
On one side of the ledger, we have the limitless futuristic promise of the digital age artificial intelligence, massive data centers, infinite computational growth, and, the dream of a frictionless economy.
Right.
But on the other side, that digital future is colliding in real time with the oldest, most uncompromising analog economic forces on Earth.
The physical constraints.
Precisely. The price of a heavy barrel of oil, the reality of borders and tariffs between nations, and the invisible, crushing gravity of interest rates. The definitive question for investors for the rest of this decade isn't whether artificial intelligence is real or transformative. The question is whether the digital future can outrun the analog constraints of the physical world.
Man, that is a phenomenal lens to view this through. Which force ultimately dictates reality? I mean, it brings us right back to our sports car analogy from the top of the show.
It really does.
You can engineer the most advanced, silent, high-tech engine ever conceived, but eventually the pavement ends, your tires still have to grip the gravel, and right now the global market is feeling every single rock on the road.
We certainly are. And, well, tomorrow's data will tell us if the road gets any smoother.
Very true. Well, that is all for today's deep dive. We hope this exploration helped cut through the noise of the closing bell and gave you a clearer picture of the actual mechanisms driving the headlines. Thank you so much for joining us on Bulls, Bears, and the Bell. Don't forget to subscribe on Spotify or wherever you get your podcasts. Keep questioning those narratives, and we'll catch you next time.